This is the lecture for Chapter 8, Consolidated Tax Returns. When looking at consolidated tax returns, the first thing that needs to be discussed is what the advantages and disadvantages may be for keeping either separate entities or combining and consolidating entities for tax purposes. This slide illustrates some of the reasons that it might be better in some scenarios to, instead of consolidating for tax purposes, to keep separate entities, separate individual taxation. This slide and the next slide list most of the reasons why it might be better or advantageous to consolidate entities for tax purposes. Got current losses that can offset income of other members and reduce current regular tax or AMT. So you can kind of mix and match the losses in the best places that they can be to overall best affect the overall entity. Operating and capital loss carryovers of one member may be used to offset income of other members. Again, basically just combining any tax benefits that one member entity might have with another entity that needs those benefits for this tax year. You can eliminate taxation of intercompany dividends, which of course can be accomplished via the dividends received deduction as well, if you're keeping them separate. Then you've got income on certain intercompany transactions that is deferred. And we'll talk a little bit more about that as we continue on. We also have some tax credits and deductions that can be utilized better when you combine everything. Like we'll talk about this later on as well, but when you have tax credits and deductions that rely on a percentage of the overall income being the ceiling of how much you can deduct. If you consolidate entities and not everyone has those deductions or credits, then you might, the overall entity's income or the overall consolidated group's income may push up the ceiling level of certain deductions and credits. And the basis in stock owned in lower tier entities is increased as income is reported. Of course, there's not always going to be advantages. We also have some disadvantages of filing a consolidated return. It's not always going to be sunshine and roses. All of these are pretty self-explanatory. Once an election is made, binding on all members for current and all subsequent years' returns, so it's not like you can jump in and out of it super easily without going through a process. The election can be terminated if the IRS consents to the revocation or if there's changes in the group and a new member is not included in the election. So again, like I said, it's not like you can just jump in and out of the consolidated group kind of at a whim. Losses on intercompany transactions are deferred. Certain deductions and tax credits may be reduced if limitations are determined based on the activities of the entire group. So we talked about how that can be beneficial in the last couple slides, but also remember that if you've got like a minimum floor based on income, or the positive side to consolidating can also be a negative in certain circumstances. Basis in stock owned in lower entities is reduced if losses from subsidiary are reported. Well, while the lowering of the basis of stock ownership in lower tiered entities within the group might not have been the first thing you think of as a disadvantage, it should be pretty obvious that anything which has these extra reporting and administrative requirements is going to, at the very least, raise costs because it's more work. So that is definitely a consideration. Basically, when we're talking about any more information or extra steps for anything related to accounting or really any personal services type work, it just means the dollar signs keep going up. So this is a very basic list of the hurdles that need to be cleared in order to join a consolidated return. Of course, each of these three hurdles requires more in-depth explanations to really understand. So everything we've gone over in the first 6 or 7 slides here before this one is more or less summed up in this graphic here. We've got advantages and disadvantages of consolidation in the bullet points at the bottom, and those basic requirements in the top 3 colored boxes. So affiliated groups are similar to controlled groups when we're talking about a parent-subsidiary relationship, but they're not exactly the same. Okay, so when we talk about a consolidated return, we're talking about a controlled group, but we also have this status of an affiliated group. So look at the characteristics of an affiliated group, and then after that we'll look at what distinguishes affiliated and controlled groups. So for an affiliated group, we've got the basic definition here: exists when one corporation owns at least 80% of voting power and stock value of another corporation. This 80% test must be met every day of the tax year. So you're not just looking at the last day of the year. There are multiple tiers and chains of corporations allowed within an affiliated group, but you must have an identifiable parent corporation, which just means that 80% of one corporation must be owned by another. So affiliated groups can file tax returns in either of 2 ways. Either each member files a separate return, or they can elect to file an affiliated or a consolidated tax return. So no 100% dividends received deduction is allowed for payments among group members when the consolidated return is filed. And the election may only be for federal taxes, may not be binding for state purposes. So you see 2 examples here of corporate group structures where the one on the left qualifies as an affiliated group and the one on the right does not. We've got a brief explanation in the top there of why the one on the right does not and what the differences are. So now we get down to the differences between affiliated versus controlled groups. Like I said, they're similar but not identical. The definition of a controlled group is, well, let's see, is one of those the definition here? No, I guess these are just stipulations that are characteristics of the controlled group. So tax benefits are required to be shared amongst the group, including the 150 or 250,000 accumulated earnings credit. Must defer recognition of realized loss, and we already talked about that a little bit, but on intercompany sales until sale is made at a gain to a non-group member. So as long as it's staying within the controlled group, you can't really recognize the loss. And depreciable property that's sold intra-group, any gain on that must be recognized as ordinary income. So here we have the slide with the definition on here. Again, you'll notice that very similar definition to the affiliated groups. One corp owns at least 80% of the voting power stock value of another. But this test, you'll note, instead of having to be met every day of the year, is calculated only on the last day of the year. Again, like the affiliated groups, you can have multiple tiers of subsidiaries and chains of ownership, and again, you must have an identifiable parent that meets that 80% threshold. So regardless of whether you meet all the requirements to be allowed to elect to be a consolidated entity for tax purposes, there are certain entities that will never be qualified regardless of other characteristics. So corporations established outside the U.S. or in U.S. possession, tax-exempt corporations, insurance companies, partnerships, trusts, estates, limited liability entities, or other non-corporate entities. So not only can they not be part of a consolidated group, or I guess I shouldn't say not only, but one of the issues that comes up with that and why that's important to recognize is the let's say that you have a parent that's qualifying for the election of consolidation for tax purposes, and then the group consists of one of these ineligible entities, then removing that entity may end up disqualifying the other members of the controlled group from being able to make that election. So of course, if they're disqualified, none of their characteristics can go towards the consolidated group, and they're just treated as a separate entity. So the following 3 slides list the formal compliance requirements for those entities wishing to be considered a controlled group for tax purposes. The initial consolidated return must include Forms 1120 and 1122, which are only filed on the initial return, and the election must be made no later than the extended due date of the parent's own tax return. For subsequent years of consolidated returns, Form 851 needs to be included. Estimated tax payments are required to be made on the consolidated basis, starting with the 3rd consecutive or consolidated year, and each member of the consolidated group is jointly and severally liable for tax liabilities, including penalties and interest of the group. So, of course, corporations in general are required to make estimated tax payments. This is just noting that those estimated payments need to be on the group level, so the overall consolidated level starting that 3rd year. So up until then, each individual corporation may be allowed to make estimated payments based on their own taxable income, but once you hit that 3rd year mark, then you have to be going on a consolidated basis for the estimated payments in addition to the consolidated return. This jointly and severally liable statement there is important because it means that if the group is late or has some unpaid tax liability, including any penalties or interest, any one member of the group could be targeted for enforcement of that. So, even the lowest tiered subsidiary, if for whatever reason the IRS thinks it's easiest to go after that subsidiary to collect, they don't even have to, let's say they're filing some type of lawsuit or taking some other action to try to recover this money, they don't even need to go after the group as a whole or even the parent corporation. They can go after any one of the corporations, and when they do, they don't have to just go after that corporation's pro rata share of the liability. They can attack the lowest tiered subsidiary and ask for the whole bill payment from them. So joint and several liability is not that much fun for those subjected to it. These are a few important notes on tax liability and accounting periods and methods. Regular tax is determined using the corporate tax rate on consolidated income. It should be pretty obvious. Tax year of a parent must be used by all members. That will sometimes result in a short year return for the first year when a subsidiary is coming into the consolidated return and doesn't already have the same tax year as the parent. Accounting methods in place at the date of the election continue to be used. The next 6 slides will cover some essential information related to the stock basis of subsidiaries, which you might remember can end up being a potential reason not to consolidate in the first place. This was listed on both the positives and negatives of potential consolidation of returns. So the parent corporation's basis in the subsidiary stock is the acquisition price at the outset, and then it's adjusted at the end of each tax year. These are items that increase the basis in a subsidiary: allocable share of consolidated taxable income for the year, allocable share of consolidated operating or capital loss of subsidiary that could not use the loss through carryback to a prior year, and contributions to capital of from the subsidiary. These are the items that decrease the basis of a subsidiary entity. Allocable share of consolidated taxable loss for the year, the allocable share of operating or capital loss carryover that's deducted on the consolidated return, which did not previously reduce the basis in the subsidiary's stock, and dividends paid by the subsidiary to the parent out of earnings and profits. Whenever the aforementioned increases and decreases end up creating a negative balance for basis in the subsidiary, then an excess loss account is established. The purpose of establishing this other account, called the excess loss account, is twofold. First, it allows the consolidated return to recognize losses of the subsidiary in the current year, and second, it enables the group to avoid reflecting a negative stock basis in the subsidiary. The balance in the excess loss account balance for any subsidiary turns into a capital gain to the consolidated group if the stock of the subsidiary is redeemed or sold to a third party. The stock basis computation is a bottom-up calculation beginning with the subsidiary that is furthest removed from the parent. Each entity still tracks its own earnings and profits separately from everyone else in the group. Deferred gains and losses on intercompany transactions are immediately recognized within individual entity earnings and profits accounts, and each entity's earnings and profits balance is reduced by its own allocable share of consolidated tax liability. We take a sequential approach when computing consolidated taxable income. Each entity's separate taxable income is calculated. Any items considered group or intercompany items are separated off to be dealt with on an individual basis. After the group items and intercompany items are dealt with, which more detail will be coming and can be looked for later on in the slideshow, and of course your book talks in greater detail about this as well. All of the separately calculated taxable incomes are then combined with these special items to arrive at the total consolidated taxable income. Computing taxable income in this sequential manner allows items like charitable contributions and capital gains and losses to be accounted for on a consolidated basis, which is usually beneficial. This is kind of what we were talking about in, I guess exactly what we were talking about in some of the advantages of consolidation, is that items like charitable contributions, which place a ceiling on the amount that can be considered tax deductible, well, assuming not every member of the group is using that full amount. If one member is using more than that amount, then they may be able to use all of their charitable contributions as deductions because they're basically allowed to borrow some of that limit from other members. We also have, let's see, when looking at intercompany transactions, some are deferred and some are eliminated from the calculation of taxable income altogether, like dividend payments. This is a summary in visual graphic form of the taxable income for an individual consolidated group, or the calculation, I should say, of taxable income. An individual entity's separate intercompany transactions are usually canceled out by the effect on the other group entity involved in the transaction so that they can remain with individual entity taxable income calculation, but when netted together with the individual taxable income calculation of the company that was the other side of the transaction, they effectively get netted out when the consolidated return is filed. When members involved in intercompany transactions have different accounting methods, a deferment is usually used so that both sides of the transaction can come through and be recognized in the same consolidated return. So this allows, again, the transactions to stay with the individual, the calculation of the individual corporation taxable income, but a deferment is used for whichever side would be recognized first, so that it nets out whenever in the same tax year on the consolidated return. The usual handling of net operating losses for corporations is still used with respect to consolidated entities. These are some special considerations when handling net operating loss for consolidated entities. Remove consolidated charitable contributions and capital gain or loss from taxable income. These items have their own carryover periods and rules. Consolidated dividends received deduction remains a part of the consolidated net operating loss. When a group member enters or departs from the group, complications arise. The member's net operating losses end up either being incurred in a separate return year and deducted in the consolidated return year, or vice versa. The formula, or this formula that's shown here in green, is what is used to handle complications that arise when the members of a consolidated group change. You take the members' separate net operating loss, the members' aggregate net operating losses, one over the other. So the separate net operating loss, aggregated net operating losses would be the denominator there. Multiply that by consolidated net operating loss, and what you get is the members' apportioned net operating loss. These are the effects of net operating losses on the member entering or leaving the group. In years when a group member files a separate return, only the apportioned net operating loss may be carried over, and when a member leaves the group, any apportioned share of unused loss carryforwards can be used on the subsequent separate returns. When net operating losses are carried forward from a separate return year onto a consolidated return, the consolidated return can include only the lesser of the member's current year income or the cumulative positive contribution of the member to the overall group's current year consolidated income. All of the following items are removed from individual members' separate taxable income and computed on a consolidated basis. Net capital gain and loss, 1231 gain and loss, section 163J, interest expense limitation, various tax credits and recapture amounts, casualty theft, gain and loss, charitable contributions, DRD, dividends received deduction, net operating loss. Yeah, that's all of them there. Any limitations in these items requiring use of taxable income will then use the consolidated group's taxable income as their limiter. So this is what we talked about already, where often advantageous because, for instance, with charitable contributions, if you have a limitation ceiling that's based on your overall income and your overall income is increased substantially without the proportionate increase in charitable contributions, then you may be able to recognize and deduct more in this tax year than you otherwise would have been able to. Intercompany gains and losses associated with sale of assets and performance of services between group members receive deferral treatment. The deferred gain or loss is included in consolidated taxable income when either the sale is transferred outside the group, or the transfer of property leaves the group, or the overall consolidation election is terminated.